Traders often look at the bond market for clues on how the U.S. economy will perform, specifically the yield curve.
Given the yield curve inversion,
we inverted back in March.
Yes, we now have an inversion.
Even if the yield curve inversion happens again and happens persistently.
The president tweeting out crazy inverted yield curve.
So what is the yield curve all about, and why is everybody talking about it? The yield curve is just a graph showing the relationship between short-term and long-term interest rates of U.S. Treasury notes. Usually the short-term rate is lower than the long-term one. But if you are lending money to the federal government, which is essentially what happens when you buy a Treasury note, you are taking a bigger risk by letting the government have your money for a longer period of time. So you're going to want a higher interest rate to compensate you for taking on that risk. But sometimes this relationship changes. If the two rates start getting closer together, that's called a flattening yield curve. If the long-term rate dips below the short-term rate, that's what we call an inverted yield curve. And the market is concerned about it.
Investors waking up this morning to a recession warning from the bond markets.
The Dow plunging more than 800 points, sparked by a key economic indicator faltering.
A brutal day on Wall Street, stocks plunging as the yield curve inverted, sparking fears that a recession could be on its way.
The yield curve's predictive power has made it a crucial metric for investors and policymakers alike.
The reason why we watch the yield curve so closely is that it has been an incredibly accurate predictor of recessions. Every time that yield curve has inverted, the economy eventually has gone into a recession.
You can see that predictive power on this chart. It shows the difference between the long-term 10-year and short-term 3-month Treasury rates. When that line goes below zero, it represents an inversion, and those inversions have preceded every single U.S. recession going back 50 years. But it wasn't until the 1980s when policymakers started to catch on.
Back in the late 80s, the yield curve was being referred to as a possible leading indicator of the economy. And I was asked by my bosses whether there was anything to this, whether you could prove statistically that there was a relationship.
Arturo Estrella is one of the economists who helped discover the predictive power of the yield curve while working with a colleague at the Federal Reserve Bank of New York.
By early 1989, we were not only seeing the predictive power in general, using historical data, but we actually saw an inversion. So at that point, it seemed to be indicating that there would be a recession about a year later. And our presentations were met with a lot of skepticism, but the recession started.
Hi, it's Tisha Powell, and I'm just reminding you to subscribe. We have over 1.6 million views. This is how you're going to learn money, and it's free to subscribe, and there will be a surprise once we get to 100,000 subscribers. One subscriber will be surprised, and we'll be surprising subscribers every month after that. But we've got to get to our numbers, so subscribe and check out the tag products. Here's an example of a tag product today. It's brought to you by Ulta Beauty. It is nice, it's gorgeous. There's nothing over $100 on our tag products. So some of the tag products are only $6, $13. You've got to see it. It's stuff that you can use for your body and your face. And some of it is popping up on the screen as we speak. I'm Tisha Powell. You probably see my face on Fox News or Newsmax. Subscribe to our YouTube channel, and you'll be surprised how much you learn about money. We'll be back to talk about the bond market. So that was CNBC, and they're talking about the yield curve from bonds. So we're just covering bonds. You might be saying, yield curve? Okay, well, first of all, you need to know what a bond is. So this is the bond market. It's a buy and sell fixed income debt securities. And then there's primary bond market and secondary bond market. And you know what that means, right? Primary versus secondary. Some are resale and some are just initiated. So what type of bonds do you have? You have corporate bonds, you have government bonds, you have municipal bonds, you have emerging market bonds, and you have mortgage bonds. I'm sure you heard about 2008 with the mortgage-backed securities. Those are all like mortgage bonds. I'm sure you've heard that the government has bonds, so you could buy bonds from governments. How do you make money from bonds, you might be saying? You make it two ways. Either the interest payments, so you get paid every month or every quarter on interest, or you sell it for more than you paid. So let's say you put $5,000 in a bond, a government bond, and in 5 years it's worth $10,000. you'd sell it for 10. 10 minus 5, your profit is 5. Let's say you put 5,000 a bond and they're paying you 10% interest per year, then you are getting $500. So that's how you are paid on your bond. Bottom line, you're putting up money, you're going to get more. So bonds, they're fixed security. You buy bonds, loan money to issue fixed period for time, and it's an investment. You've got to weigh your risk versus your reward. The bond market is an investment. And where would you buy bonds? Okay, so the fact that you have bonds is good. You know, mutual funds, some of them have bonds as well. But you don't want to stick your eggs in all one basket. You don't want to have just Bitcoin. You don't want to have just real estate. You don't want to have just bonds. And you don't just want to have mutual funds. You want to have a little bit of mutual funds, a little bit of bonds, a little bit of real estate, a little bit of Bitcoin. That's how you diverse your portfolio. And it's important for you to diverse your portfolio because none of us have a crystal ball. We don't know what's going to happen. 2 wars are breaking out now. It's a time to diverse your portfolio. So where do you buy bonds? You buy it from government, you buy it from a broker, you buy it from ETF. Most brokers, most bonds require a minimum requirement of $5,000 to get in. So you need at least $5,000 to get in on a bond. So just save $300 a month or $500 a month in 10 months. That's $5,000. So are there any advantage and disadvantage with bonds? You bet you. Any investment, any asset you buy, there's always pros to assets and there are always cons. So let's look at the pros of the bond. They are low risk, high return, high liquidation. So let me explain that with you. Real estate is not very liquid. Also, stock market, not always liquid. It goes up, down, it's volatile. Bonds are easy to liquidate, okay? Because it's a fixed amount of money. You said, I want my money today. The bond man sells the bond and you get your money, okay? So it's very easy to liquidate. What are the disadvantages? Well, when interest rate goes up, the value drops. Also, the bond might not do as well as the inflation because the yield for the bond might be less than the inflation. And they can recall the bond early. So you could think, oh, I'm going to get 20% on this. And they just said, you know what? We're going to call in the bond early. So that's the basic of bonds. I'm Tisha Powell. We'll talk more about bond yields and everything else. This is a channel that talks money. So subscribe to learn more. Subscribe to learn money. We've had 1.6 million views. We thank you for that. But it's free to subscribe. And we have surprise once we hit 100,000.